Welcome to the weekly update, where I'll go over the action in the market for the week of July 1st through the 5th, and then we'll see how things look for July 8th through the 12th. Before I get started, I had a long day of teaching English online today. I teach to Chinese children using video software, and I had a pretty long day. My voice is starting to go. I'm going to do the best that I can as I get through this video. So I ask for your forgiveness in advance if you hear more throat clearing than usual and my voice is not as strong as it typically is. I do all these videos take one. I just hit the button and I start talking. And so that's where you get all the mistakes. I don't do any editing because I can post these videos a lot faster by just doing it that way. And I sent out a message a year and a half ago, and I said, hey, do you think the edited videos are much better than me just clicking the record button and talking? And nobody really complained about it. So I've just stuck with it since that point. Before I do get started, please know that I also do daily videos. Now, I know people are busy and some of you have very long-term portfolios. I do address that in the program that I have. I have a really long-term program that I teach as part of my strategies and what you can do when we run into difficult times. But I also do videos every day. That's the real foundation of the analysis and commentary that I provide. The weekly videos and the other videos that I post, I see as supplemental videos to the daily videos. So when you can, if you get a chance, check one of those daily videos out. They are available on the day they're posted, but right when the market closes. Members in the program have first access to the daily videos. Let's say it's a Tuesday video. They have access all the way up until the market closes. Then boom, right when the market closes, I have a timer on that video and it immediately goes public at that time. About half the people that watch the videos that I post watch it after the market closes. And that's even when they were available while the market was open. So some people still find that to be a useful resource to consult. Also, I do post a PDF in the description below every video that I do post. It includes the slides that you see here, as well as the charts that I use in that particular video. Sometimes I'm going really fast, and downloading that PDF gives you a chance to actually look at things that I'm saying on the slides and showing you in the charts. And there are people that find that helpful. I do also update every day a thing called pivot points. There's two different charts. One is updated every day, but those pivot points last for the entire month. We had some new pivot points kick in on July 1st. There's also intraday pivot points, and those do change every day. That's where I look at a 10-minute intraday chart, and we have support and resistance levels in that chart, and you'd be surprised at how accurate they are. You can find those on the YouTube community tab. I can't post those on Rumble. I don't really have the means to be able to do that, but feel free to check those out as well. I do have a private Facebook group that you're welcome to join. Now, let's say you want to have some back and forth and conversation with me. I keep that private Facebook group. It's always open on my computer. There's not a lot of interaction now. I pretty much just post a link anytime I upload a video. But let's say you don't want to be a member, but you still want to be able to ask some questions and maybe throw some ideas back and forth. The private Facebook group would be a good place to do that. And apparently they ran some new webinar through Fiverr or something. I'm getting hit with all kinds of comments again, especially on Rumble, about all these social media experts that want to help me build my channel. I delete those comments because I want to keep that free and clear for legitimate comments. I don't get a lot of comments on my videos. A lot of that has to do with the fact that I don't really throw a lot of opinions around in my videos. I just show the charts and the charts speak for themselves. But if you do want to offer something, either positive, negative, you want to challenge something that I say, you want to agree with what I say, it's all welcome. You're more than invited to be able to do that. But I get rid of the garbage comments. They get deleted right away. Even if you disagree with me, that's not a garbage comment. It's the spam comments or the crap comments that, hey, join this Telegram group and pay $2,000 a month and you're going to be wealthy for the right, all that garbage. That goes away quickly. All right. I do post on Rumble, sometimes on either platform. I might have some trouble uploading a video, either on YouTube or Rumble. That's why I post in two different places. It's kind of a backup. If you're expecting to see a video that I do post and you can't find it on one platform, jump over to the other one and see if it's there. Also, I do have a program that I've talked about. It started at the beginning of June. Right now, it's wide open and it's free. I was going to start locking it down in July, but I've kind of ran into some logistical issues with doing that. So it's still pretty much wide open for the time being. I have the basic course that's been re-recorded. There's an additional video that I've been adding every day about some position ideas that folks may consider. There's other things that I do want to roll out, but I'm not going to roll those things out until I can actually lock things down. I have well over 100 hours of courses that I've developed myself. I'm recording. I want to wait until I can lock things down before I actually make those available on the website. And that's when the members are actually going to be paying a fee. The fee is $97 a month once that finally gets up and going. If you want to hear more about the program, there's a link in the description. If you want to see more videos where I talk about the program, there's also a link in the description. Another thing that I kind of alluded to already is if you look at this diagram here, the daily video is the foundation of everything that all the conclusions that I reach. Every once in a while, I'll get a comment that says, okay, I like the intermarket analysis video, but what's the point? Well, if you've only seen that video and only that video, I can understand why you would be confused about that. The intermarket analysis is to supplement the daily video. This video I'm doing right now, the weekly video, it's to supplement the daily video. And I also do a deep dive video, charts that I don't really talk about in the week. And there's some other charts that are unique to that video. And then what has become kind of popular, at least on my measurement of it, is a what to watch video. That's the last video that I do each week where I really hone in on what I'm keeping an eye on. There are supplemental videos. There's a few that are on the channel right now that you can go back and look. Any more supplemental videos going forward from here are just going to be on the SPX Investing website. Those are going to be for members, and I'm going to be covering some topics that I just don't want to unleash to the public that I don't know. I'm going to be dealing with some topics that at some point can be controversial. And I want to be able to at least have some kind of an impact on what I'm teaching without getting all these crazy comments from left field that really don't matter or really don't pertain to what I'm talking about. And inside the program, that's a little bit more defined. Another YouTube channel that I would recommend, he takes a bit of a longer approach than I do. It's Shivako Capital. He puts out a video. His name's Chris Shivako, and he does a video. It's usually available Friday night or Saturday morning. And I make it a point to watch that video each week. Now, it's longer term than I look at. So if you are a longer term portfolio, you run your own portfolio, or you're managing your retirement account, check him out. He might have some things that you find really beneficial. I have no connection with him. He doesn't know me. I only know him from his videos. There's no, type of relationship there where he's helping me and I'm helping him. As an educator, I make a promise to myself and to my students that anytime I come across a good source of information, I'm going to share that with people, even if it's not me. Okay. Now he does take a longer term approach than what I do. He's a money manager where I'm an educator. So that's one channel that you might want to consider. Another channel is a guy named Bob Kendall. I do subscribe to his newsletter. That's as far as our relationship goes. He has no connection. He doesn't even know who I am. I only know him from his videos, but he seems to be pretty sober in his judgment of the market, has some unique indicators. He's been around a long time, has some good experience that some of you might find helpful. Let's go back and talk about this week's session. Now, they didn't update the weekly brief at briefing.com, so I'm kind of making this up myself when we get to the bullet points later on. We were up 1.95% for the week from Friday to Friday. Volume was below average. We were closed on Thursday for the 4th of July, and we've been below volume or below average with volume pretty much all week. So that is dropping off. We are positive in the short, intermediate, and long term on the daily charts. There are some vulnerabilities that we're seeing, and watch the daily videos to get more insight in that. And I'll try to point it out as I go through the charts here. But we're still looking good here on the weekly charts as well. Bigger picture, the trend is still up. The areas of concern that we're seeing right now have to do with more internal measures that we're looking at. And this week coming up, it'll be more about inflation and interest rates. We're going to get CPI on Thursday. We're going to get PPI on Friday, especially CPI. That's one of the really big inflation reports that the market really pays attention to. We want to keep an eye on all the different geopolitical things going on. There's all this upheaval about what's going to happen with the presidential election. That's happening in the US. They just had an election in the UK. They're in the process of having an election in France. That's causing some instability and just a lot of back and forth going on. And then, of course, we have a couple of wars going on right now. And most of the time, those things don't impact the market unless they get extreme, unless it's something out of the blue that the market wasn't really anticipating and it's really bad and the market may react for a short period of time that way. And then we do have the upcoming week, Chairperson Powell will be testifying before Congress. One day he'll go before the House, the other day he'll go before the Senate. He pretty much says the same thing both days, but it's the question and answer session that the market really pays attention to see, is he giving us any hidden meaning as to what's going to happen with either Fed policy or interest rates. Our trend right now, we are still strengthening. It's positive. And I'll show you that chart here in just a moment. The green line is above the red line. That's why we're positive. And after the up week that we just finished, the green line is starting to go back up. So longer term, we're still looking quite positive. Here's the bullet points that I came up with. We did have a 1.95% advance for the S&P, but it was on below average volume because of the holiday that we had. The mega caps, that's really what's holding the market up right now. I've been trying to spot some kind of sector rotation because we're not really seeing, we're seeing internal weakness when it applies to the S&P 500 and the NASDAQ 100. It's just a few stocks that are driving those indexes higher. And the rest of the market is not necessarily falling apart, but it's not showing an awful lot of strength right now. And that's what's causing us some concern. And so there is this internal weakness. And again, I hit that a lot harder in the daily videos. The employment situation report, which is probably the most influential economic report of the week or of the month. And then next week is the other one, which will be CPI. And then we get core PCE later on. This was taken as soft. Now, right now, bad news is good news. And that's why the market went up on Friday. They thought, okay, maybe the Fed's going to cut interest rates in September. But too much of that could eventually get to the point where bad news actually becomes bad news. And that's what I do by watching the market, because there are periods of time when the market will shift from one way to the other. About a month or so ago, bad news was becoming bad news. And then we had some good news and the market went up after that. Well, because of this inflation and interest rate fear, the market is typically liked it when the economic reports have been weaker than expected. But the employment situation has remained very strong. And that's what the Fed has used to justify, first of all, raising rates and then keeping them there for where they're at right now. If this employment situation is starting to show some weakness, that could, at least at first, sound positive for stocks. But if that continues, that could actually turn over negative. And then there's still this fallout from the presidential debate that now was over a week ago. And it's producing a lot of uncertainty about the presidential election, specifically on the Democratic side. Is the current president going to continue to run for re-election? He says yes. A lot of people are saying no. We don't know how all that's going to turn out at this point. Interest rates did fall on the week. We were at 4.34%. We fell and ended up closing at 4.27% in Friday's session. And the dollar index also fell. Both of those together did give support for stocks to go higher. I don't have the updated chart here. This is from a week ago. This is a chart that I've been showing for over a year now, where we're comparing what happened in 1966 up through 1982. That's the blue line. This is CPI year over year. And it was going up, then it was going down. Well, we've been coming down. And the reason why I can show this chart, even though it hasn't been updated, we're still in this downward move right now. What we're just keeping in the back of our mind is, okay, what's going to happen after this? And everybody's predicting whatever, that we're going to continue to fall, that we're just going to skyrocket to the moon, or we're going to go sideways. Okay, fine. Let people make their predictions. We follow charts here and we follow the data that is available to us. The concern that I see from this chart is we were declining from 76 into 77, and I was growing up during that time, but then we saw massive inflation after that. Is something like that going to happen this time? I'm not saying that's what's going to happen, but I'm not saying that either. I mean, we could see something could happen to impact the US economy and really send inflation up more than it's already been going up over more than the last 40 years and what we've seen. That's just something that we want to keep in the back of our mind. But you'll get all kinds of opinions out there on YouTube videos and Rumble videos and people that post things saying that they know what's going to happen. That's not the way I do things. I watch the data as it is released. We look at the evidence and then we just follow it day by day, week by week. Another thing is RenMac a long time ago came out with this research that said that whenever we get above 4.02% with the 10-year yield, that's when it starts really biting into corporate profits. And we've seen a slowdown. Even though they're going up, they're not going up as much as they had been, because now we're at 4.27%. We're above that 4.02 level. Isabel Ned, this is a chart that I show every week. This is the earnings projections going forward, both from Morgan Stanley, that's the dark blue, and then the consensus, which is the light blue. And that's why I put this red arrow on here. They're just continuing to go up, even though they may not be going up as strong as they were a year or two ago. This is still going up nonetheless, and that's ultimately what drives stock prices. Then looking at the inflow to gold, and I'm not into this since March 2024. My God, that was just a couple months ago. Who cares? Even if it was 50 years ago, who cares? We have to look at the context of how these things are playing out. But we are seeing money going back into gold lately. A lot of money just really think that's where the good gains can be found. And then since we did get the employment situation report, we also get this all employees, including temporary help services. That's the red line. When we typically drop below with this red line coming down with this horizontal red line here, that's often when we go into a recession. And these are the grayed out areas that you see. Well, we dropped below this, but to date, we have not entered into a recession. That doesn't mean we won't. It just doesn't mean that that's happened, at least as of right now. Then June 24th was the first month, and I didn't know I guess this was June 2024. I didn't realize, okay, since October 20, and I'm not into this crazy comparing to another time frame stuff. What we're seeing is that no central banks are hiking rates right now. It's gone down to zero. So then that's what we're seeing globally. And then only 30 stocks make up over half of the index. This is what you've probably been hearing about. Way over on this side, and this chart's a couple weeks old now, but 53% of the S&P 500 members, those are the big stocks that really contribute to what the S&P does. FactSet did have a blog post this week, and it was no post a week ago, and it says that analysts made smaller cuts than average to the earnings per share estimates for the second quarter with those companies in the S&P. And right here where I'm circling with the laser pointer, that's what they're talking about. Yeah, they're making cuts, but they're not as much as the other cuts that they had been making. And then over here, it's just some bottom up where they're looking at the actual earnings of the companies and then working their way higher. We can see how this has been actually playing out. I mainly focus on this chart here. And even before that, I tend to focus mostly on just the headline. Looking at the intraday chart, where Monday, we did end up going down here. We got down to the 54.50 level, and then we were able to bounce up off of that. Not anything really all that strong on that day, even though it was an up day. Then on Tuesday, this is where we saw some strength coming back into the market. We were closed for Thursday. Then Wednesday, this is also when we saw, you can see, we started to get some real strength going behind the market. Then we were closed for the 4th on Thursday, and we, after a pretty choppy open, after the employment situation report came out, we ended up just resuming that upward trend. So from the low that we set on Monday to the high that we set on Friday, this is pretty solid movement, just showing that we're really going higher. And it has a lot to do with the really big stocks that are influencing that. So for the week, and this is just the 4 trading days that we just finished with, the NASDAQ 100 was up the most, followed by the NASDAQ and the S&P. We did have the mid caps and the small caps. They were down. If you go Monday, Tuesday, Wednesday, Friday of this week, going back to the beginning of the year, small caps, at least as measured by the S&P small cap index, they are the only index that remains negative, and they did not have a very good week. As far as the sectors, this goes from Friday to Friday, where the discretionary, and this is an area that we've really been disappointed with a lot in 2024. Well, Tesla had a pretty good week, and they're in the discretionary sector. So that was the sector that ended up doing the best, and tech and communication. These are the three areas that if they could continue to go up, they've really been driving things so far. And if discretionary could get back in and show some follow through, these could really help the market to go higher. Or energy ended up being down the most. Then on the next slide, I show what's called a scooter score. 0 to 100, the higher the score, the better looking that particular sector. We had the tech sector and communication well into the 90s. And even though discretionary was up, it's just right under 80. It's at 79.2 right now. And then the weaker areas have been real estate and materials. Then looking at the week, just the 4 trading days, where we had discretionary, communication, and tech, with staples being up just a little bit. All of the other sectors that make up the 11 sectors for the S&P ended up being down. Going back to the beginning of the year, the strongest sectors are tech and communication. All of the other sectors are down when you just look at them by themselves. Then I look at another different approach here. This is the relative rotation graph. You have to remember back to your geometry class. Up in the right-hand corner, these are the strongest areas. The lower left-hand corner, these are the weaker areas. If it's green, it's positive, and the longer the tail, that means the more strength that particular trend is having. Well, we have the utilities, which have been strong. Now, this goes back a year, not a week, not a month, not a quarter. So this is showing some weakness compared to what it had been doing. Then we have tech, which had been showing a little bit of strength, and it's getting stronger now, where a lot of the other areas are starting to show some weakness. Real estate has been bouncing up just a little bit compared to what it had been doing, but it's still not looking all that strong. Then here is just a breakdown of what we saw in that graph, where we have utilities and tech. They're looking the strongest with the green areas. Then we have a few areas that are more or less neutral, like real estate, discretionary. Then what's really neutral has been communication over the last year. And then we have all these red areas that continue to be underwater. Then I look at the indexes and I go back over the last year and I compare them with the Wilshire 5000, where we have utilities, which are trailing off here, but they're still pretty strong. The NASDAQ 100, the S&P 100, and the S&P 500. These are the big companies. Utilities are starting to back off a bit. And these other areas like mid caps, they were stronger earlier in the year. Now they're getting weaker. Small caps have been disappointing. The Dow Jones Composite also showing weakness, and the transports are just not helping out in the rally that we've been seeing over the last year and a half to 2 years. Here's another look showing this, how the S&P 100, NASDAQ 100, utilities are still strong in the S&P 500, where the red areas are those different indexes that are really struggling over the last year. Looking at sentiment, we saw a real bounce up. We were down into the fear area. Even though the S&P was setting all-time highs, sentiment was down well into this fear camp. Well, then it bounced back up on Friday, and we ended up closing at 54, where we had been at 44 on Thursday. And here is showing you this chart. So we're a little bit more positive now as far as sentiment. When we're below 50 and just kind of bouncing around the way we have been, then we have more of a negative approach to sentiment. Now that we're going back above 50, we can shift back a little more positive. The active asset managers, this is a bit of a concern. These are professional money managers. What are they doing? What are they doing for their clients? Well, a lot of them are getting bullish. In fact, maybe a little too bullish. We're getting a reading well above 100 right now. And these folks are human beings. They have emotions. They have people they have to answer to. They have peer pressure that they have to, did you get into NVIDIA? Well, I did. These guys all talk with each other, and I use guys in a generic sense, but they're getting a little optimistic here. And sometimes when we get a really high reading, that's a bit of a warning sign to us. Now, it doesn't mean we're just going to turn right here and go down. It just means that, okay, an awful lot of these folks are really positive. And when the whole party is going in one direction, we're starting to at least look at the idea of possibly looking in the other direction. Here's that same chart showing that we came in at 103.66, and that's a pretty high reading. It's up there, the highest that we've seen from 2023 into 2024. This is the VIX, which measures fear. We were actually up a little bit on Friday, even though we had an up day. But we're still showing that fear is very, very low right now here on a closing basis. And then down below, this is the bar chart showing you the movement throughout the week. The Ulcer Index, which was mainly designed for mutual funds, which you can only go long in them, and they only have one price every day. I still like to show this. It just shows that there's not a lot of fear, especially when we're below the moving average. This is the spread between risky and not as risky bonds. Now, this chart doesn't look all that scary right now, but the next chart's it's giving us a little bit of a warning sign. When this is going down, that just means there's not a lot of fear in the bond market. But we do an inverted version of that chart. And this was actually developed by David Keller from stockcharts.com. And I wanted to put these on the same scale with the S&P. As the S&P has been going up, you notice here how that spread, that's the chart we just got done looking at. We inverted it, and this is a shorter term time frame. This is starting to actually go down, which means over on this chart, it's actually starting to go up, but it's really hard to see. Whoops, I didn't mean to go that far. This is a bit of a concern to us. If this keeps going down, that could be quite negative for the bond market and for interest rates. We want to see this continue to go up here or down on the previous chart. And then just to give it a little bit more context, we're still showing that the VIX is giving us very, very low readings, which look high on this chart because this is also inverted. The latest reading from Investors Intelligence came in at 3.73. When we get really nervous about this is when we pop up above 4. Then the RIDEX bear bull ratio. When this is going up, folks are more bearish. When this is going down, folks are more bullish. And these poor folks have just been getting gyrated all over the place now. Right now, they tend to be more bullish, and we're getting quite a low reading with that. There's really no change from the American Association of Individual Investors, and that's you and me here. And when they start to get really extreme positive, we look at using this as a contrarian indicator. Same thing is true when we get extreme negative. While it's going in the direction of this moving average, we can roll with that. Well, there wasn't much of a change here, even though the bulls dropped off and the bears increased a little bit. It was the neutral area that kind of expanded, and it ended up not giving us much of a change from the previous reading. This is still positive now. When we compare cash with the tech sector, with the black line going down, that means the tech sector is outperforming. And if you're more positive on the market, that's what you like to see. Looking at the latest readings from GDP now, that's the green line that we have. They have us coming in at about 2.75% or so. And then if you look at the top 10 and bottom 10 forecasts, we're coming in at about 2.5% to the upside and about 1.5% or so to the downside. This also represents what we're looking at here in the second quarter for 2024. Again, what I usually say with this chart is the takeaway is that GDP remains positive, at least for right now, because one of the parts of a recession is that GDP is negative for 2 consecutive quarters. There's another look at GDP where these consensus areas are the black diamonds that you see here, and then the gray area, that's what Goldman Sachs thinks. And so they pretty much are already done with the first quarter. Now they're starting to focus on the second quarter. The takeaway from this is that most folks are still expecting GDP to remain positive. We look at the Chicago national financial conditions. It's continuing to be below this black line, and that's a good thing. When it goes above the black line, that's when we get concerned. Then we did have the real-time Somme Rural Recession Indicator that was updated on Friday. We're getting a little close to this red line. That's causing us a bit of concern right now, but we haven't gone above it. You can see other times when we go above the red line, that has typically led to a recession. So we're just going to wait and see how that plays out. Here's a post by Chris Schiavocca, who I mentioned closer to the beginning. And then he retweeted something from Nick Tamaris. He's supposed to be some inside guy that really knows what's going on at the Fed, but Chris Schiavocca is the one that I really pay attention to. It said June unemployment rate of 4.1% did not trigger the Somme rule. We didn't go above that red line. Okay, so that's positive for right now. And here's another look at that chart. It's the 0.5 level that we're trying to stay below currently. Then the smooth U.S. recession's probabilities were underneath this black line. When we get nervous is when we go above the red line. Then the Bray Butters was updated because we ended a quarter here. It's continuing to come down overall after we had been going up. So this is not really pointing to any problem right now either. Inflation, we're starting with a new quarter, so we're pretty much flatlining until the CPI and PCE reports come out. This is what everybody's talking about. Well, not everybody, but anybody who kind of follows what's going on in the market. As of the close on Friday, when the Fed meets on July 31st, there's a 92.2% chance that they're going to leave rates unchanged. We're at 5.25 to 5.5 now, and they think that's where rates will remain. And this is, if anything, getting more locked in. The dark blue is the current reading, and then we have a day ago, a week ago, a month ago, and this has been rising up to that consensus. The big change that we're seeing in the anticipation that the market is building in is there might be a rate cut on September 18th. Now, we don't know if that's actually going to happen. The market's been trying to front run this ever since the Fed started raising rates. But right now, there's a 72% chance that they're going to cut rates 0.25% at that meeting. That's what the market thinks will happen. And we're getting even more a little bit convicted here with the employment situation report that came out. We're seeing more people thinking that there will be a rate cut. Now, this could always change. Something could happen, whether it's a black swan event or the economic reports don't feed into it, or the Fed comes out and says something. Especially only pay attention to Jerome Powell. I know it's a federal open mouth committee and these people like to give their speeches, but it's really what the chairperson says. That's what is the most important. And then looking at the Fed balance sheet, where over here it continues to decline, but you see where it's actually going up in the latest reading. The market likes that. Now, this is a form of quantitative easing, which they promised they would never do, that now is pretty much expected. And this has been really giving some support to the market. And then looking at the year-over-year changes, where we're going up based on a year ago, even though we're dropping off on the year-over-year reading. And then this is the overnight reverse repurchase agreements. We just want to keep an eye on this. When we're running into more problems here, the Fed will kick this more into gear, and that might mean the banks are having some problems. The fact that we're coming back down to a lower level here, that's giving us a little bit more confidence. But if this really starts to spike back up, we will notice that. Looking at the breadth, where we look at the advanced decline line based on price, we're still above the moving average. We're also above the moving average based on volume. Looking at the new highs, new lows, this is another internal measure. We're hitting all-time highs with the S&P. We're not necessarily breaking out with the new highs here, but our 4-week moving average continues to go up, but we're declining with our 10-week moving average. The advanced decline ratio did come down a little bit, but we're still above 0. And I made a little change here. I have a thing that I didn't come up with the name. I came up with the indicator a long time ago. I just never gave it a name. It's called the boom indicator. And it tries to measure how far away do we get from one of these moving averages, either above or below. And that's what's plotted down here. Well, the accumulation distribution is starting to get kind of far away. And we're seeing this on the daily chart as well. And this could mean that this is a smart money indicator. And when this gets really far away, that may mean some kind of exhaustion, because this indicator not only takes price into account, it also takes volume into account. And because we're going above this red line, which I put on here, this is an arbitrary line. It's just when we get to this level, this is where we want to take note of this. Looking at our trend, this is what I talked about earlier, where the ADX is going back up and it's above its moving average. So that's a strengthening trend. The green line's on top, so it's a positive trend, and it started to turn back up now. So that's giving us more of a confirmation there. The Erin indicator, the green area are the buyers, the red area are the sellers, and we're getting a pretty extreme positive reading here. The mass index is not generating a signal. And then we look at a daily chart. This is one thing that I noted in the daily video. We came right up to this pivot point, and that was pretty much the high on Friday. Are we going to be able to break through that on this chart? These pivot points can become quite influential. On the bottom, you see we're pretty much the whole week, we were below average. Then when we look at the Keller market model, this is put out by David Keller from stockcharts.com. We're negative in the short term with the mid caps and the small caps. All the other time frames are positive. Then we look across the market. where we're still negative with bonds based on the long-term outlook, and we just switched over to a downtrend with the US dollar on a short-term basis. No changes with the decision point scorecard. They're just all pointing up and looking wonderful there. We're still well above the midpoint of this trend channel going back to 2009 and continuing to go up. If we break out even a little bit higher, I'm going to extend this trend line out. This is something I've been showing in the daily videos. This is a weekly chart of the S&P. For the third week now, we have closed above this R2 level. And that is quite positive because other times along the way, this ends up being pretty significant resistance. Well, we broke above that 3 weeks ago. We stayed above it, and we even closed further above it after Friday. So that is looking quite positive. On a trending basis, we are positive with our 50-period simple moving average, and that's 50 weeks. And prices above, and both are going up. Then I use a crossover type of method where I take a 13-week moving average and a 50-week moving average, and the blue line is above the red line and prices above both. So the S&P is still in a long-term uptrend. This is where we're seeing a little bit of internal concern right now. The McClellan oscillator, we're setting all-time highs with the S&P. We're down below zero with the McClellan oscillator. So we are declining with the summation index, but we're still slightly above zero based on price. We turned up just a little bit based on volume, and we're seeing that on the daily chart too, because this is one of the internal measures that I look at. You would think with us getting to all-time highs, the summation index should be going up, at least based on price. Well, it's showing a little bit of an improvement here based on volume. So that's giving us a little bit of positive hope. We look at the Swenlin trading oscillator. We're below zero in declining based on price, and we're seeing that same thing on the daily chart, where we're looking a little more positive based on volume. The bullish percent index, this has been rather disappointing. We're hitting all-time highs with the S&P. The bullish percent index is actually going down. This is not a moving average. This is not an oscillator. This measures the point and figure buy or sell signals inside of the S&P 500. And when you're seeing this going down as the S&P goes up, that just means there's a small number of stocks that are really controlling the S&P, which is like Microsoft, Google, Apple, NVIDIA. If those stocks really get hit all at the same time, it's really going to drag the indexes down. Then we look at the momentum. We're trying to maintain some kind of a positive stance here with the PMO. This is the price momentum oscillator. We're still below zero, but ticking up based on price, where we're declining and still above zero based on volume. So you see some of the contradiction that we're seeing. So we look at the PMOs on a weekly basis that are rising. That's going down. The buy signals are actually going down, and we're declining with the PMOs that are above zero. This is measuring some of that internal weakness that we're seeing. And we're seeing this on the daily chart and the weekly chart, which is kind of strange here. We closed a little bit above the upper Bollinger Band right now, and that's what the percent B measures. And this doesn't happen very often. Now, it doesn't mean we're going to reverse and go the other way, but it does mean that we might be due for more sideways action until this wears off. Then looking at the momentum, we're still going up with the slope and the TSI. Those are short term. Then we have 3 intermediate term oscillators, which continue to be positive. Our longer term oscillators, the TRIX and KST, they're showing some improvement, but still looking more negative. We're slowly starting to shift a little more negative on the daily charts, pretty much across the board. Chicken money flow, another smart money indicator, seeing a little bit of weakness on the daily chart, and we're actually declining here on the weekly chart. That's a bit of a concern to us. We want to see the green line going up, or this histogram here, and we want to see the red moving average turn and go up, and it's actually declining. Chicken oscillator continues to decline even though it's still above zero. That's a concern to us. The force index is still positive, above zero, and the money flow is giving us an extreme positive reading. The rate of change was up because we had an up week. The rate of change going back 50 weeks is still above this red line, not really breaking out, but not necessarily breaking down either. The RSI based on the last 14 weeks is back to extreme positive. The weekly special K chart just will not turn positive. The daily special K chart is positive, but we continue to be below this red line. The Stochh RSI, a momentum oscillator, is extreme positive. The Williams percent R is also extreme positive. This suggests pretty good momentum for the weekly charts. The ultimate oscillator is turning back up and is still positive. The vortex, we saw the green line coming down, but it's still on top. We want to see the green line actually going up. Topic curve, it's negative on the daily chart. It is positive here on the weekly chart. We didn't come down and hit any of these support levels here, so there's really nothing to show on this chart. We're starting to go back up with our 253 period simple moving average of the equity put call ratio. We want this to go down if we're more positive. We are going down when we look at the VIX and then the 3-month average of the VIX. The red line continues to decline. And we're looking fine on a trending basis. We look at the Heiken Ashi, we have open candles. We're going up with the Kegi chart, up with the Renko chart, and up with the 3-line break chart. The ease of movement is still above zero, even though it's flattening out slightly, going back over the last 14 weeks. There were no new X's or O's drawn here on the point and figure chart. We're still working off of a double top breakout that was generated on May 13th. Looking at momentum here, longer term with the PPO, we're starting to go up in the long term. We're pretty much flat, but still looking positive overall in the intermediate term. And we're flat to still looking kind of okay here in the short term. But all three of these charts are weekly charts. Here's the 50-day cycle. We hit it on June 4th, and we're in that right now. I'm not sure what to make of this. We are positive when we look at the Elder's Impulse system for the S&P on the weekly chart. We're positive on the daily chart with the parabolic SAR. We went negative for a couple of days, but then we switched back to positive, and we're also positive here on the weekly chart. Looking at the broad market, we're now, whoops, I should have put the arrow over here. July tends to be one of the stronger months where we're over the last, well, going back to 2020, we've been up 100% the last number of years with an average return of 4.4%. And we look at the S&P all by itself hitting all-time highs. The mid caps are negatively diverging from that, and the small caps continue to chop sideways. The Dow continues to be in an uptrend. The NASDAQ hitting all-time highs and in an uptrend. NASDAQ 100 hitting all-time highs in an uptrend. Here's a weekly chart of the NASDAQ 100, also showing that we set a new all-time high there on Friday. The mid caps stronger earlier in the year. Now they've been really coming back down, but they're still in an uptrend. The small caps, did I say small cap? I meant mid caps here. Small caps have just been chopping sideways, but they're still in an uptrend. The NYSE did not set a new all-time high, but is still in an uptrend here. The Wilshire, this is a daily chart setting an all-time high after Friday. All stocks continue to be really in a solid uptrend. The biggest software companies in the U.S. showing a little bit of improvement here, possibly avoiding a longer-term death cross. The FANG index set a new all-time high on Friday. ARK not really doing all that well, saw a recent death cross here. The banks are holding up for right now. We're above 50 with the RSI. The momentum continues to be negative, but they were actually down slightly on the week. Deposits. Few people are, it looks like they're coming in and taking some money out. Maybe they had to pay for their 4th of July barbecue. But here we look at money actually going into banks in the latest reading. Then we look at just a weekly chart of Dow theory. The Dow is not setting a new all-time high. The transports have been really underperforming, and utilities, which had been coming on strong, are now starting to pull back. The broad market, we look at the weekly chart of the CRB index, still in an uptrend, but it did fall slightly this past week. Oil is getting back up into the 80 range again. Is that because of strength? Is that because it's summer? Is that geopolitical? That's what we're trying to figure out. Copper was up almost 6% on the week after it really had been falling. We're starting to see another longer-term uptrend develop here. The dollar was down, even though it's still in an uptrend, both on the daily chart and here on the weekly chart. Gold has just been chopping sideways, even though you got all these folks that just believe gold's the end all to everything. Pretty much, what was this? Since about April, it's really been choppy, not really moving all that much. Silver also chopping, but still in an uptrend. We look at interest rates. These are bonds based on price. We were up on the week, and we continue to be in uptrend with the total bond ETF. There's a monthly chart showing how stocks continue to outperform bonds. This is looking at the yields where they really dropped in Friday's session, and that gave support to stocks. Here's a weekly chart looking internationally with US, UK rates and German rates actually going up, where US and UK rates came down and Japanese rates are starting to go up. Those are the ones that are in red. Some relative studies. First, we look at an intermarket analysis chart, and then I have a whole separate intermarket analysis video that I will do. Going back to the beginning of 2024, oil is doing the best, followed by stocks, and then gold, and then the dollar. Bonds continue to be underwater based on price. Then we do a ratio between the NASDAQ 100 setting all-time highs and the S&P 500 setting all-time highs, but the NASDAQ 100 is even outperforming the S&P. The S&P 100 continues to really outperform the S&P 500, even though both have been doing really well. Growth to value, this is what we want to see. We're going up. This is buy low, sell high when we compare it to value, which is more of a defensive type of investment that folks get into. Gold, you see where it's not really doing all that much compared to the S&P? Yeah, it's in an uptrend, but ever since we crossed over, we've been going underneath both of these lines. And then gold to the dollar. Since the dollar was down and gold was up, we're starting to show a little bit of a breakout, but not above this previous high. And then this is a weekly chart showing how bonds continue to underperform stocks. Low volatility stocks really underperforming. These are the stocks that folks get into when they're more defensive, and the money managers get into when they're afraid we're going to have a decline, and hedge funds and all those people. They continue to really underperform the S&P. That's more positive for the S&P. Discretionary to staples had been in a downtrend, but we saw a bit of a bounce here as Tesla had a pretty good week this past week. Heaven help you if you shorted that stock right before they released that information. And then energy to tech, we take a ratio. This is just showing that energy continues to underperform the tech sector. Then we look at the NYSE breadth thrust. We're still working off of the same signal that was generated back in October 2022. And that's pretty much indefinitely going forward now. Then we have the SWAG NYSE breadth thrust. We're getting close to this point. We still have a little bit to go with this particular signal here. We almost had one signal again back in April into May. We were one day off before we actually saw that signal triggered, but that may be positive enough, as some people have said. And then this just shows that the last valid signal that we saw, we don't really know what's going to happen 12 months going out, but these WAG NYSE breadth thrusts, they are pretty stinking positive with a few exceptions along the way in the shorter term time frames. The NYSE Zohorchak method, this is very long term, and we remain on a full-on buy signal and pretty much have for all of 2024. Here's a long-term chart of the S&P. Going back to the 1987 crash, we're well above the trend line. This is that same chart showing how we're just continuing to break above that longer-term trend line. And we're still going down here. When we look at the NYSE new highs minus the new lows, we're slowly starting to turn positive on the daily chart. This is a 50-period exponential moving average, and this is declining even though it's still above zero. For the broad market to turn back more positive, we want to see this red line turn and go back up. This is just looking at the S&P 50-period exponential moving average of the new highs minus the new lows. This is also continuing to decline. That's a bit of a concern to us. Looking at the NASDAQ 100 weekly chart, we're well above the trend line now. When we look at the NASDAQ 100 to Dow ratio, we're breaking above these previous highs. And the QQQs, the small caps, we're also breaking out and setting new highs with this ratio. Semiconductors holding up quite well when compared to the Dow. We're still not really seeing a lot of improvement here. This is a cumulative new highs and new lows for the NASDAQ. We want to see this turn and go back up after it had been declining for years. It was starting to go back up, and now we've been drifting more or less sideways. On the bottom, this is a daily version of the new highs minus the new lows, and we're just right a little bit positive there. I think that's positive. It's hard to see. I think it's either a +3 or a -3. It's really hard to see that. We're also keeping an eye on the 3-month yield, where we've been just chopping sideways. We don't want to see what happened back in 2007, where they had to massively lower interest rates because we were going into the great financial crisis. Then the Hindenburg element, we're not getting a signal right now. There are some perma bears out there that think, oh, we're close enough, everything's going to fall apart. We did not get a confirmation on this signal when we look at it for the NYSE based on the S&P 500. We're getting all kinds of signals, none lately, though, with the NASDAQ, but those didn't really seem to matter. We got all these confirmations, but the NASDAQ just kept going up. Seasonally, we're kind of look at it this way. Based on a seasonal basis, the first part of July looks pretty good. The second half of July, not so much. And that's kind of what we're seeing here. We see July going up, and then we see typically during an election year that will drop off later. Also, when we compare 1982, that was the start of what led up to about the year 2000. We've been following that along, even though I haven't updated this chart. July tends to be pretty solid when we look at the monthly returns going back to 1950. That is one of the stronger months. And then when we look internationally, take the whole world together, July is a pretty solid month. Then we take June, July, and August based on Carson going back to election years. June tends to be pretty good. July, good, but not as good, where August tends to be a little bit better. That's after the conventions. And then this is Stock Traders Almanac. We're following this pinkish line here. We're actually coming into July now, but what we're really following is this red line. This is the top first quarter during election years. That tends to do better. And that was kind of what we were following earlier on, but you can kind of take your pick. The takeaway I'm getting from this is that we tend to see positive returns during election years. Doesn't mean there aren't a few bumps along the way. And then this is the seasonal pattern from 1949 to 2023. We're coming into July now. We see a nice little start to July before it tends to fall off based on this chart. And then looking at the NASDAQ, where it tends to see a really solid start to July before it ends up falling back as well. And then it tends to look better going into the rest of the year. Then we look at the seasonal pattern, looking at 2012 and comparing that, because we're kind of sticking with that. This is quite outdated now. There hasn't been any new updated charts here. So we're just wondering if we're continuing to follow along with that. Then here's another look at June, July, and August, where they tend to perform well during the fourth year of a presidential cycle. And then when we look at July and break it down since 1950, that's the kind of yellowish area. Past 20 years, that's blue. The past 10 years, that's green. And then during an election year, that actually performs the worst, according to this. And then looking at the seasonality from 1976, where we tend to have a pretty good start to July, and then possibly see a little bit of weakness after that. And then this is what we've been doing, at least up until the early to middle part of June. And then looking here, the first 10 trading days in July have historically been the strongest period of the year. But then the second half, it's positive, but not all that gangbustery. Yeah, there's a new word for you. Here's looking at it a little different way. The first half of July tends to really do well. The second half is just not all that great. This also shows going forward from here, July into August, we tend to see an overall uptrend, even though we do see down moves along the way. Then looking at election years going back to 1950, we have a 50-50 shot, up 9 out of 18 times, down 9 out of 18 times, with a return of 0.7%. And then one more here, where during an election year, the NASDAQ, it tends to do quite well here during an election year. And the S&P also tends to do quite well. This is 2003 to 2023. Thank you. I really hope you found this helpful. Please feel free to check out the other videos that I post. Have a wonderful weekend, and I will talk to you in the next video.